You're running full speed, but the markets are faster. Quasar Markets Live brings the world's top financial minds to you. Everything you need to know in one place. Learn from elite educators and gain a competitive edge, leveling the playing field for you. Join the conversation. Quasar Markets Live.
Good afternoon, Quasar Markets Live. I've got him again, Michael Litt. Global investment strategist. And if you listened to us a few weeks ago, and of course, the last one, you know, you were well prepared for the market sell-off. Michael, how are you today, man?
Good, Stephen. As good as you can be in these changing times. It reminds me of an AC/DC concert I went to back in the day with Angus all over the stage, you know, and that's kind of how the markets feel. And if people are feeling a little dazed and confused, I think you're in good company. So we'll try to bring everybody, get 2 feet firmly on the ground today and see if we can give some broader perspective. I think people are getting hit with a lot of news and information that's changing rapidly. Today we're going to try to really set some foundations for everybody to.
Yeah, I mean, you think about it. I think the world was kind of set. We knew what was going on, and then all of a sudden, flip-flop. The president says, "Hey, look, 90-day hold on these tariffs." Things kind of changed. Market popped 12% at some points yesterday, and of course, we're seeing a pullback today. Not quite as heavy. But is this now where we can all go home now and not worry about this anymore?
No, I think there's actually a lot of structural issues that are going to get sorted out. As we said 2 weeks ago, as we said 4 weeks ago, when we reiterated our sell the rallies messaging.
Right.
2 weeks ago, and we were trying to pace this thing, we laid out the administration's goals, right? We talked about them wanting to shrink the government, reduce the deficit, level terms of trade, create manufacturing jobs in the U.S., lower taxes for people making under certain amounts, under 150,000, no tax on tips, making research and development deductible, deregulate banks, energy, and housing. Those were their primary goals we laid out. We did that in detail last week. Today, the goal was to talk about the market implications and the risks of the implementation strategies not working out. Now, things have moved quite rapidly, but we're going to stay with that plan today. And the one thing I want to touch on before we get into the details is when you study classical economics, you learn that going all the way back to Adam Smith, economics is a struggle between capital and labor for share of the pie. Underlying the administration's goals is this reordering the trade system so that U.S. labor gets a larger share of the pie. We pointed out that Besant has said explicitly, as have others, J.D. Vance, that they are not focused on what the Northeast Corridor thinks. Really are listening. They really care about serving the populist cohort that elected them.
Okay.
Investors need to understand that labor getting a bigger share of the pie is going to come at the expense of investment capital.
Right. You say that, and of course, the understanding of this market and the understanding of the investors, and of course, you just said it yourself, the voters themselves, that everybody believes that President Trump was pro-business. I mean, is it pro-business or is he pro-U.S. business? Do you see a difference in there?
That was the headline. That was certainly what people believed. You're correct. I think even somebody who voted for Kamala Harris probably would have said, yeah, that's true. But they have laid out that they want to charge countries for access to the consumer, the U.S. consumer. They have set up this, Lutnick has said, we have what we call the External Revenue Service, which is going to tax producers to access our consumers. They believe that the foreign producers pay for that tax. The National Bureau of Economic Research found that the tariffs that were put on in the first administration of this group largely accrued to consumers and producers in the United States. This also causes retaliatory impact, and it generally contracts the global economy. So that policy is not business friendly.
Yeah. And when they come out with the policy, I mean, the stocks dropped 20, 30%, and they weren't happy, right? I mean, were the tariffs just oversized there? I mean, too many countries. It was like all countries at one time. I mean, what happened there?
Well, in the immortal words of Elon Musk, Peter Navarro is...
Yeah, of course, he called him a moron, right? And dumber than a sack of bricks. I mean, that's a kind of a tough sale in the White House, right?
Yeah, we talked 2 weeks ago about there being disagreement amongst the cabinet members and between Bessent, Doge, Lutnick, Navarro, President himself. Navarro is leading the administration's reordering of global trade right now. And you heard Musk's critique. They do not believe the classical view on tariffs, that consumers lose more than domestic labor or producers gain, that input costs rise, and overall capital is finite, so you have to reduce production if your input costs are going up. Production is shifted to less efficient, higher cost producers. Okay, and smuggling and black markets emerge. Retaliatory tariffs result in further deterioration of trade activity. We're already seeing that. Resulting inflation creates demand destruction and lowers GDP. Again, not business friendly. But they don't believe those. They take it, they just don't believe that. And I'll tell you why. First of all, they take a dim view of academic findings and data. We've heard that.
Why? Why are they taking a dim view of economics from a perspective of you and I? We went to school for this stuff, and we've learned from every person all the way down, and they're just kind of throwing the books out the door, right?
Yes, I'll tell you an interesting thing. I really, as you've seen from 2 weeks ago, I do respect Scott Bessent quite a bit.
Agreed.
But he made a point, and he said, we don't like how CBO is scoring our budget for the budget reconciliation, because they're keeping taxes the same. They don't think there should be any increase in the projected budget deficit. But the CBOE had the tax reductions coming off, so taxes would have gone back to a slightly higher level. It wasn't a huge tax increase, but it was higher. But they don't want to recognize that. They want to score their own paper. They don't want the teacher to score their paper.
CBO is the Congressional Budget Office are Republicans. They run that office now. So that's no people.
And the point is, I said this to somebody today, that if the taxes stay the same and don't go up, which was what the Republican CBO had in the projections for the deficit, then taxes are going to be lower in the new projection if the existing tax regime is extended. So they don't like data. They want to score their own paper. They want to make their own, look at things through a lens of their own device. That's what I'm reading through. Just because of that simple example, it's clear to me that that's how they want to view the world. The truth is that tariffs, another reason they don't want to believe is they say, well, those tariffs were and this is true, historically tariffs were done on a industry by industry basis and on a country by country basis. So think of Japanese steel, right?
Right.
That was how a tariff was applied. What they say is we're doing macroeconomic tariffs across the board on every country at the same time, so they think it's going to be different. The truth is, what this is called mercantilism. It's an economic model, and viewers should look up the entry for mercantilism in Wikipedia. It's an economic, it was written by some economic historians I know. It's really well written. Mercantilism was replaced by free trade and fiat currencies 200 years ago. So in a way, this administration is taking us back in a time machine to the year 1825 to Charles Dickens' England. Now, it's not full-on mercantilism, but it is neo-mercantilism, okay?
And describe the difference between mercantilism and neo-mercantilism.
Mercantilism is where you're essentially, you have your borders closed, you only manufacture things internally, and you export pretty much exclusively, and the emperor or king or leader of the country is just trying to accumulate as much gold and silver as they possibly can.
So you're saying it's more like a China feeling more like maybe India too as well in a lot of ways, right?
Japan, when Shogun, when Japan was closed.
Wow.
Right? I mean, mercantilism was in place, and in Europe, you had mercantilism in Europe, 16th through the early 19th century. But Adam Smith, John Locke, we started moving towards free trade, and now China still has a neo-mercantilist construct, and that is a problem. That there's no question that, and India to a lesser extent. Okay,
but you would think that this administration and Republicans in general and conservatives are more into free trade and capitalism than they are into this. I mean, I hate to say 17th century feeling of mercantilism. I mean, this is getting really deep in the woods. I mean, in a lot of ways, right? And you would think that. I think you're saying that protectionism of this country is at an all-time low. Is that what you're saying?
Well, just before GFC, we hit economists have done a few people that have done some great work on this. Tariffs hit a 400-year low in 2007, 8, 9.
Okay.
From what was troubling was they did start to slowly, very slowly, rise off that all-time low. So there's been a little more protectionism over the last 15 years, which gave this administration a slightly larger target to shoot at. I will say that, Stephen. But there is no question in my mind that it's this neo-mercantilist impulse that is very dangerous for global economic activity and financial assets.
Okay, so if it is neo-mercantilism, I have to ask, out of the economists that are in the White House, so you're saying that they're no longer describing to the feeling of that we're in this capitalistic free trade, so we're going this old model again. Who is saying this? Is it dissent? Is it Navarro? Is it President Trump? I mean, who is taking us back to the 300 years here, essentially?
It's not clear. They're either trying to do one of two things. They're either trying to eradicate mercantilism globally by truly getting tariffs back down to that all-time low and below that all-time low from 2000, let's just call it 2008, okay? Or they're trying to set up a neo-mercantilist model in the United States.
So is this reconfiguring global trade in general, the whole world over, or is it just the United States? I mean, it seems to me that President Trump is upset about our trade differences with all these countries because they're all different. They've all got different feelings to it. They've all got a different reasoning behind it. We've heard everything from, the diseases to your cars to, and I think in some cases they were talking about fentanyl. He's used so many different reasonings. But what is the overall global reasoning of saying, okay, Japan, Vietnam, Cambodia, you're in one pocket. Russia, China, India, you're in another pocket. What is it that's going to make this all a little more even keel, so that makes us as investors a little bit more happy, I should say.
Well, Mark Rowan made an interesting point the other day on CNBC. He said this was not the best way to go about, not the best plan to go about this. We probably should have done bilateral trade negotiations. And I'm going to get to this later, but the order of operation was not well thought out. You have to realize something, Stephen. A trade deficit is not as big a burden to it's something that he's been egging for a fight for 40 years, since the 80s, since he took out the big ad paper. A really smart money manager I had lunch with made a point to me that I really stuck. The trade deficit has allowed us to import disinflation and export inflation, which has increased the standard of living and the purchasing power of everybody, from the $15 an hour worker all the way up to the, private equity firms buying companies who can manufacture. And we've talked about this, and the reason I was very bullish for the 4.5 years from May of 2020 was because of the expansion in the profit margins, the margins of 12-13% for the S&P 500 companies versus the 5 or 6% back in 1980, is the reason that to believe in American exceptionalism.
Right.
Okay, a neo-mercantilist model. If the administration is trying to use this as a means to an end to get fair trade and level tariffs around the world, that could be a good thing. You could go through a painful process to get there, and people want to believe that.
Yeah, I mean, the painful process to me this has been painful already, but I have to ask, I mean, is there any other time period that's been a lot like this? I mean, I'm looking back and I can only think of a few myself, but is there a time period where we see the same thing?
Well, yeah, McKinley put tariffs of this magnitude on in 1900. In the midterm elections after he did it, the Republicans lost 75 out of 175 seats in the House. It was the worst percentage loss of House seats ever. And the reason was because inflation surged. The IMF has done some work on macroeconomic tariffs, because we don't have as much economic data on macroeconomic tariffs broadly applied. But they did some work for the 1964 to 2014 period. What they found was that countries shifted distribution channels and supply chains away from the tariff country. Trade fell quickly, but only recovered slowly. So if this persists, okay, earnings are going to take a pretty severe hit, and it's going to be difficult for them to recover in the aftermath.
But this is not McKinley's administration. It's a little different, right? I mean, he's using people that are from business. He is using people from the media. McKinley had a little bit of different take on that. I mean, you almost have to ask, I mean, what is the end game here? Is he using it to negotiate for better terms? It seems to me this is sledgehammer politics more than it is taking a microscope and a scalpel and trying to figure out how to fix the problems here. I mean, what is this going on here?
The hope strategy is that it's the former, that he's just using it, that the administration's using it as a means to an end.
Okay.
I see some problems in that, though. First of all, you've heard this messaging about build factories. Build factories in the United States. It's going to be a great place to manufacture because we're going to protect your industries. Have you heard that message?
I have, yes.
Okay. That doesn't sound temporary. If you, Stephen, were telling me these are only going to be on for 12 to 18 months because the economic damage will be too great, go ahead and build a factory. I'm not sure I'd
Yeah, I mean, you heard Apple talking about it. Tim Cook saying, "Look, it would cost me $30 billion 3 years for only 1/10 of my production," and they just shipped gobs and gobs of Apple iPhones over not too long ago, a couple days ago, right? So I get it, but to me, this feels like a huge tax increase on everybody, right?
It's a you know what? And the other thing, it's a massive tax increase on the U.S. economy, which again, that's not pro-business, Stephen. This External Revenue Service believes it's charging the tax on foreign countries. That's why they call it the External Revenue Service. The truth is, U.S. consumers and producers are going to pay somewhere between 60 and 90% of that tax at the end of the day, based on what National Bureau of Economic Research found. Here's the problem now. The administration's bluff has been called.
Okay.
Time is not on the administration's side. Even if it is just a negotiation and a means to an end of lowering mercantilism globally, let's assume the bet.
Okay.
If it takes a long time to get there, and if the IMF research on macroeconomic tariff policies is right, and supply chains and distribution channels move away from the United States, you have lasting damage. About a week ago, I came to the conclusion that if enough countries call the administration's bluff, China is going to end up being the big winner here.
Yeah, and you saw it from the Apple perspective that, and a few other companies like Nike moved all of their manufacturing out of China into Vietnam, right? They were ahead of the game in a little ways. That even they saw the protectionism in China and the imbalance that we had, and it's a lot easier to deal with Vietnam than it is with China. So we already get that, and I understand you're saying that China becomes the big winner. So let me ask you this a little bit different. I mean, look, the tariff on China became 54%, then it became 104%, it went to 125%, and now a few minutes ago, 154%. Just came out a few minutes ago. Look, I have to ask, I mean, how does China become a winner with 154% tariff on their plate?
Great question. But remember, when China threatened Taiwan 3 years ago, or 4 years ago, companies started moving production to Vietnam. What did the administration do last week? They slapped a 46% tariff on Vietnam.
Mm-hmm.
So you didn't make any friends there. And if with somebody who was really kind of supposed to be your diversifying, savior in terms of secure supply chain, right?
Right.
What did you do? You slapped a 46% tariff on them, right? Remember, that doesn't mean the price is going up 46%. That means the raw materials costs are up. The parts or the product coming in, now the distributor marks it up.
Right.
Now the retail store or Amazon marks it up. You're probably talking about 100 to 150% increase in price, Stephen.
Yeah.
These are enormous price shocks. The ships that were at sea from Shenzhen and Shanghai ports turned around mid-Pacific and have headed back. U.S. manufacturers will not be getting the parts they need to complete building.
And you talk about the Shenzhen province. I mean, at one point, I guess maybe even 20 years ago, this almost all the things were made in China, right? And you would think that in the Shenzhen province alone, just the sheer number of Chinese people that will lose jobs. You call China the winner, but China, the consumer, China, the employee, China, the employer, is going to lose here, and especially with the tax revenue from China too, as well.
Yeah, it's going to create. Well, first of all, the global economy is going to take a hit. China's going to take a hit. Global economy is going to take a hit. Mexico and Canada are going to have to ramp up production as U.S. factories can't get parts. Right? There's still going to be demand. People are still going to try to finish building a house, a building, a car. People are going to be that black smuggling and black markets are going to emerge pretty quickly, Stephen. Tell the young, the Gen Zs, forget about digital marketing. Black market and smuggling are now the growth industry. Price gouging. You're going to get price gouging. It's absolutely going to be a reality by the summer. Short-term countries are going to try to negotiate with the U.S. The administration will be able to announce better terms of trade in the short term. But I think back to China, supply chains and distribution channels are going to shift away from the United States at the margin.
And go where?
There's going to be tension between, say, China and Europe, China and Vietnam, because they're not going to want China to dump product onto their markets, but they're going to try to come up with bilateral trade arrangements, because in the same way that people didn't want to do business with China after the Taiwan scare, guess what's going to happen with people thinking about their business relationship with the United States? They will look as much as they can. Now, you can't run away from the $20 trillion U.S. consumer, but at the margin, what you're doing is you're going to shift supply chains and distribution channels and just business away from the U.S. The entire global economy takes a hit. China takes a hit, no question about it. But the reordering of global trade is not what the administration had envisioned. It's different, and it does benefit China. Look, U.S. farmers are losing access to China, okay? Yeah. That's going to hurt. Medium and long term, I think these supply chains shift away, and it hurts the U.S. and it helps China, and it really elevates China in the whole global picture.
Let's ask that question. I mean, Ukraine, Zelensky just said yesterday and today that they've captured Chinese soldiers on the front line, meaning Russia and China are trying to get together, meaning that is the world realigning so that it's China, Russia versus United States and the rest of the world?
That's tough for me to know, because you capture a couple of mercenaries. I'm not going to read too much into that. Okay. I think that the reordering that had been envisioned by this administration is not the reordering you're going to get, given the part that Mark Rowan made from Apollo. This was not the best plan, the order of operation.
But some people would argue, Michael, that there wasn't a plan, that Scott Bessent finally is bringing a plan. And are we right or wrong? Was there a plan or was there not a plan? Because this seems like chaotic a little bit out of the White House. And it seems like, yesterday you saw where Bessent says, hey, here's the plan. And it seemed that the markets really enjoyed that, loved it, and the markets jumped. But now we're back to the fact that we're not sure we have a plan again.
Yesterday, the 90-day standstill or stand down was not a plan. That was a necessary move because the world had called the administration's bluff.
Right.
That was they just lost a rook. Okay. Mm. And that was not a plan. I think Musk knows a little bit more about whether there was a plan or not than I do. His comments on Navarro are a big tell for me. So I'm not sure. I think there's a tendency not to listen to economists, to want to believe their own internal conversations. I think Musk's comments reflect the wisdom he saw in that room of that decision making. I think the feeling like an AC/DC concert reflects that to some degree. The market volatility, you have some, Stephen, there are some really, really bad markers here. The dollar is deteriorating. And remember, when the dollar goes down, it deteriorates the wealth of the nation.
Right.
Be clear, 1-to-1. It used to be 100 years ago that you got your trade picked up. 50 years ago, you got some trade pickup. 20 years ago, less trade pickup. Today, services economy, Apple can't, because the dollar goes down 10, 20, 30%, doesn't really impact the cost of that $30 billion factory or all the input costs and supply chain components. It doesn't work that way anymore. All you did was reduce the wealth of the country and everyone's savings. Bond yields are backing up. Treasuries have suddenly gone from a flight to quality to an asset that foreigners are selling.
Right.
Foreign capital owns 20% of the stock market, 30% of the treasury market, and 30% of the investment grade bond market.
Right.
If they believe that, and the Mar-a-Lago Compact or Accord states they want to weaken the dollar because they still believe that the reaction function of the dollar to trade is the equation that was in place 50 or 100 years ago. It's not. So all you do is you undermine the wealth of the country by weakening the dollar. That the dollar is not acting as a safe haven in these market downturns, nor are treasuries, is actually telling you something and indicates that this may in fact be a shift towards neo-mercantilism and not a negotiating position on the part of the administration. That is how I came to that, because I was like, why have these relationships that have held true since World War II,
right,
breaking down? And I think it's breaking down. We've got Q1 we were in a recession because of the weather and the import inventory build in anticipation of something like this. Nobody thought it was going to be this severe. Copper, oil, small business intentions, CEO surveys. The data is not mixed, Stephen. And everything is coming in terms of deterioration economic. We probably, for technical reasons, we probably will have been in a recession in Q1. Nobody expected us to be in a recession in Q2, but the knock-on effects of the two biggest economies in the world being in a full-on trade war mean that we're getting dangerously close to being in a recession in Q2, which was not in expectations. And I said 6 weeks ago, if that was the case, earnings for the S&P were going to get revised downward. And guess what? They've been revised down 2 or 3 times by people now. So, and the market is still expensive because rates, are still up, right? They're like 435, 440 on the 10-year.
4.388 right now.
4.388, and so the earnings have now been revised down from 275. Some people are at now 257. So the market hasn't cheapened as much. And remember, from the 20% of the stocks that are owned by people outside the United States, they've taken the hit you're looking at, plus an extra 6-7% on the dollar depreciation. Okay. Right. So, and then we have
inflation and the stocks and your home prices.
We haven't seen the inflation impact yet. We haven't seen the Doge layoff impact yet. And we haven't seen the psychological effect of what I talked about in terms of the consumer's reaction to the wealth loss.
My goodness. I mean, the doom and gloom coming out of you now, Michael, starting to scare me, but there is, I think you've said it best, that there might be an adult in the room about half a mile down the road from the White House, wears a purple tie sometimes. I mean, Powell, he's got to cut rates, right? I mean, come on, he's got to cut rates.
Coming into this year, the Fed's biggest issue was, let's go back to the, life in Eden, the Garden of Eden. He had a pretty strong economy, and the PCE inflator had risen from 2.2 to 2.6.
Right.
So they were hesitant to cut rates again because they wanted to see how inflation expectations, they weren't going to raise rates, but they were going to pause on their rate cutting. That's where the Fed was. Okay. You know, there's a scene in The Lord of the Rings where one of the kings tells Gandalf, your powers are useless here. And I feel a little bit that way about the Fed. With a neo-mercantilist tax increase, the solution for that is not in the Fed's toolkit. You're going to get inflation, and I don't mean eggs. I mean big ticket items, right?
Cars, houses, what?
Unemployment's going higher. How much higher? We don't know what the knockoff on effects. I know you have a lot of government jobs lost. Temporary workers or consultants are being laid off. My daughter's company had big plans. They were big supporters of this administration. They had plans for hiring. They just froze hiring. I don't think that's an isolated incident. Remember, this is not a repeat of 0809. This is not a credit availability or liquidity issue, which the Fed's toolkit is it's built to handle that kind of crisis. This isn't a banking crisis. It's not a credit crisis. It's not a default crisis. Investment IG spreads and high yield spreads have jumped up to 120 and 440, but they came off low levels. Your defaults are rising, but they're not super high. Even consumer, if we get inflation and foreigners are selling treasuries and rates back up towards 5%, and you've got unemployment and inflation, you put the Fed in a really tough situation. What's worse about that is they can only affect short-term rates. The long-term rates that are going to affect what corporations can borrow at 10 and 20 years, or a home buyer can borrow it on a 30-year fixed rate mortgage. The only way they affect that is they're forced into buying long-term debt. Well, now you're talking about Japan in the 2000s. Yep. That is not good for risk assets, Stephen. You do not want to be Japan in the 2000s. So again, your powers are useless here, not because of the way this was created. It's, now I will tell you in the coming weeks, our viewers should look for the administration to blame the Fed and blame China for the deteriorating economics conditions, right? That's what you're going to get.
I mean, they're doing that now, right? Are they? Isn't he really blaming Powell?
It's going to be loud, and it's not. Our viewers are going to be more informed on that. They're going to be able to process that and see it for what it is.
All right. Well, you told me all the bad news. I feel like Mount Olympus and Zeus here has told me that expect lightning bolts to come down and rain on our heads. There's got to be some good news. I mean, come on, Mike. There's got to be something here.
Well, remember in our part one, we did talk about the administration's offsets, decreasing energy prices, taxes on the $150,000 and below, tips, R&D, bank regulation. It would have been logical to do those first and start bilateral negotiations on improving terms of trade. And over a 9-month period, as those created economic stimulus, right? And a buffer, they could start meeting out country by country, where it really mattered the most, harsher terms. That probably would have been the prescriptive that would have worked a lot better. I think Bessent tries to deflect attention from the impact of tariffs and what's going on now between the U.S. and China. He's going to announce these programs, these tax proposals. They won't be in place, but they're going to be proposed in the reconciliation bill. The bank regulation he can move ahead with. They'll announce some. They'll try to get some of those out in front of the public.
Oh, great! More bank deregulation like 2007, 8, and 9. Great.
I think Bessent's smart. It's not going to be that. It's going to be things like not charging regulatory capital charges on treasuries and other things that are there's some constructive stuff in there. Again, had that been put in place, and then we did bilateral discussions, with people like China, who deserve to. I mean, China's trade policies weren't fair. We needed to go to the table with them. Probably not the right approach. And oil's down, so you're getting lower energy prices. That's constructive, not for the best reason. The two largest economies being in a trade war. Now, the Saudis are pumping oil right now because you had a bunch of OPEC members who were producing above their quota level. So they're trying to teach those oil-producing countries a lesson. So there's two reasons oil's at $59 a barrel. I think it's 59 last I looked. Let's also remember, corporate and household balance sheets are exceptional right now. They're A+. Household debt service is extremely low as a percentage of disposable income. Liquidity is very high for households, not the lowest 40%. They don't have as big a stake.
So it's good for the rich, bad for the poor, right?
Well, the rich, I would say 60% gets to the middle and working class. It's the 40% who are renters, who don't have savings. Those people, they're going to get hit. Let's be clear. They're going to get hit the hardest by these policies. No question.
And, I have to look back in history, and we'll leave it at this. I mean, there's been other examples of this. I think my parents were not happy when I was born because of the bear market in the 70s, right? And I mean, you had Nixon and Watergate. What do you got going on here? I mean,
right.
Are we going to narrow this down to a time? We call this a certain time period, like we call the Watergate investigation time period, or what's going on here?
You're right, Steve. The last positive point I am going to make is that non-financial corporate debt is at an 80-year low. So corporations like households are well positioned. Okay, so we can feel good about some of the stuff Besant's going to come with, that oil prices are going down. They'll probably announce as part of the reconciliation bill lower taxation. Households, corporations in good shape. This isn't a credit crisis, right? Looking back, you're right. It's the 73-74 bear market that feels like a little like this. No two things are identical, right? You had the oil embargo shock, which is like the neo-mercantilist tariff shock. So those are your headlines. The Watergate investigation, Nixon resigns in 74. The approval rating for this administration and the president have held up, but I don't think that's going to continue as this thing ages a little bit. So you're going to have some rhyming there. The U.S. dollar was dropping, right? Inflation pressures were increasing. Inflation went from 3.5% to something like, I want to say it was 10.5% in 24 months.
And during that period, Nixon got off the gold standard, and today we just hit an all-time high on gold. I mean, there are some similarities. I think you're totally right. Okay, I'm going to put you on the spot, Michael. If you were to name this time period, what would you name it? Stagflation. I don't think it's right. It's the economy is a lot more durable than it was back then, and we don't have the Vietnam inflation backdrop. Inflation was, remember, the Fed's problem was 2.2 to 2.6%. Right. But what you have is this is what I would call the global trade slowdown. Global trade slowdown. Is that what you're going to call it?
The global trade. It's the global trade recession. And it has to do with the largest economy in the world shifting to a neo-mercantilist economic model.
There it is. All right, everybody. Michael Litt, my friend, global investment strategist. So let me deliver it to everybody. Michael, thank you so much, and we'll see you in a couple of weeks, man. Thanks for bringing the doom and gloom.
You're welcome.